asset class deserves the description of a V-shaped recovery, it is equities, with global benchmarks now trading about 10% higher than at the start of the year. US equities are in the lead as they have benefited from heavy exposure to the technology sector, which, despite high valuations, is considered defensive, as many technology companies have benefited tremendously from the disruptions caused by the pandemic. In our eyes, there are three factors fostering the very positive sentiment towards equities at this time. One, there is a hope for further fiscal support measures by governments to replace lost incomes and, by extension, corporate profits throughout the pandemic. Secondly, unwavering confidence in certain central banks' ability to suppress interest rates and risk premia endures, and thus leaves equities as an investment without much of an alternative. Thirdly, expectations of a quick resolution to the medical challenges posed by the pandemic seem to come to fruition as vaccines and other therapeutics become available. That is definitely the case. Looking under the surface of the broad benchmarks reveals that the recovery has been driven by just a handful of sectors, chief among them technology, communications, healthcare as well. At the same time, a trend that has been in place for 10 years already of cyclically sensitive value stocks underperforming growth equities has accelerated further. By now, it has reached extremes that in the past have been rather reliable signals of an impending reversal. And with effective vaccines about to become available, such a sustained rotation out of growth into value may indeed turn out to be the big story of 2021. Among regions, the outlook for Asia and selected emerging markets is particularly bright. As the first major economy, China has recovered all of the GDP lost and has returned to its pre-pandemic growth path. Other Asian countries that have taken speedy and effective measures to bring the virus under control, such as Japan, South Korea, and Taiwan, are also seeing strong growth recovery coupled with attractive valuations. Among developed markets, we strongly favor European equities over US stocks. Not only do the former exhibit a much more cyclical makeup, but US equities are uniquely pricey. Pretty much all valuation measures range at the very top end of their historical range, and we would not be surprised if the S&P 500 were to deliver another lost decade of flat returns, as was the case after the bursting of the internet bubble at the turn of the century. Speaking of sectors, we believe that the time has come to rotate into cyclicals. This means basic materials and most of all energy, which has suffered the most in the downturn. Furthermore, there is potential among financials and banks, especially if interest rate term structures begin to steepen further. Where we are cautious is when it comes to technology. Considering the sector's tight correlation with real interest rates, economic reflation will produce strong headwinds. Furthermore, valuations have climbed into the stratosphere, prompting comparisons to the internet bubble at the turn of the century. While, unlike then, the technology mega caps that are dominating today are highly profitable, earnings growth has in no way kept pace with prices. Just take the example of Apple Computer. The stock price has doubled over the past year, yet revenues have only risen by 1%, with the stock being valued at 8 times those revenues and 30 times current earnings. Just a few years ago, the earnings multiple had been only 11. Politically, as well, the dominant technology companies are entering rough waters in the US. Under the new Democratic administration, their monopoly powers that they have built and amassed over the past decade will be under assault, with many more calls for antitrust action. Generally, at the broad global benchmark level, the return outlook for equities is not particularly promising. This is quite atypical at the current point in the economic cycle, as we are just emerging from a deep recession. However, apart from a few days in March, equity markets have never fully reflected the degree of disruption that we have lived through over the past year, and that is due to the unprecedented level of monetary and fiscal support that has been expended. As a consequence, markets are trading up by 10% and more on the year, while corporate earnings are down by 20%. Thus, all of the recovery from the pandemic and a good portion of any ensuing expansion have already been priced in. For investors, this means that a passive, benchmark-focused investment approach is likely to create disappointment over the coming years. Instead, we think emphasis should be put on careful selection of active strategies, secular themes such as climate change, and an expected sustained rotation into the value factor. If you would like to get more insights about our Outlook 2021, please send us a message.